I'd like to welcome all of you at today's event organized by Greenpeace. My name is Hajnal Krinkan. I'm the operative manager of Greenpeace Hungary, and thank you very much for coming. And so many of you coming today. The main issue today is that a new financial report commissioned by Greenpeace was elaborated, which tries to focus on the financial and economic aspects of Paks. As I mentioned several times before, in the past 18 months since the signature of this contract, the opinion of the Greenpeace has remained unchanged. It is a very expensive, unnecessary, and environmentally very unfriendly operation. In the past many years, we have experienced a huge energy revolution globally. The technological development also resulted in a new situation, and the share of renewable energies has been increasing steadily. And therefore, we believe that in line with the economic trends, Hungary should also focus on renewables. We also try to put a lot of emphasis on support our statements by facts, and therefore we decided to publish the report. We wanted to elaborate on the economic aspects of this issue. That's why we decided to try to find an independent analyst, and that has also great experience in the Central Europe. That's why we worked with Candole Partners, and I'd like to introduce you to the representative of Candole Partners, Mr. Jan Ondrich, who will present you with the main conclusions of the economic study. And his presentation will be followed by Mr. András Perge, who will give you a more idea about the main position of Greenpeace Hungary.
We were asked by Greenpeace Hungary to draft a study analyzing economics of the proposed project of Paks II, and also look into the impact on the market this project might have. Now, I will just say a few words about myself. I'm a partner at Candole Partners. We're an advisory company specializing in the energy sector. We reviewed, apart from Mochovce, we reviewed all nuclear projects in Central and Eastern Europe, starting with the Czech project Temelín, moving down to Bulgaria to look into Belene, up to Romania to look at Černá 3 and 4, then back to Czech Republic on Temelín 2, and now we're concluding, I guess, with Paks II. Okay. So what we did in our study, it's a sort of a fairness opinion on the study conducted by Rothschild, where we analyzed the underlying assumptions and we tried to take an independent look at some of the premises and some of the expected market developments. We built a financial model, which is a discounted cash flow model, and we analyzed internal rate of return and net present value of the project under various stress tests. So in summary, what we did was we stress tested the project under various market conditions. And then we implied a certain market concentration ratio, so impact on competition on the Hungarian power market if the power plant goes online. And we also assessed whether the Hungarian power market should be treated separately from its neighboring countries, or whether the interconnection between other countries is sufficient enough to allow Hungary to be treated as a part of a larger European market, which of course has a significant impact on market concentration. I already introduced us and myself. In addition to analyzing nuclear projects around this part of the world, most of our work is in the energy sector for both strategic and financial investors. And currently, we're mostly engaged on projects in Germany, financing projects of power generation in Germany. Right, so where we start from. So we start from parameters as they were reviewed or proposed by a study done for the Hungarian government. As I explained, we do not try to prove those wrong per se. We take those parameters at face value. Although we have our own opinion on some of them, such as time of construction or capex or weighted average cost of capital, we just treat them as given. And what we do is we build scenarios of power price developments, and we ask a question, what would happen if, for example, power prices deviate from those expected by Hungarian government? What's the impact on the project? And we think this is one of the most important stress tests one should do when it comes to a large infrastructure project like that, because the German energy transition changes fundamentally how we should analyze European power markets and the impact on pricing. I will get to this in more detail a bit later. And this is one of the angles which we found missing from the Hungarian government's assessment, and that is where we paid particular attention. All the other parameters we take at face value, and we also stress tested the load numbers, and I will get back to that as well. There's ample evidence, for example, looking at load levels of, for example, say a power plant, Temelín 1 in the Czech Republic, which was by the standards of nuclear industry completed relatively recently. So there is good evidence looking at how load ramps with time as the operator of the power plant goes up on the learning curve. This table summarizes the key inputs and some inputs for the alternative scenarios which we reviewed. As I said, most of the parameters come from the Rothschild study. On the O&M side, though, we thought the boundary proposed by the Rothschild study was too narrow, so we decided to run a few more scenarios with numbers coming from the French Court of Auditors. Again, we appreciate the fact that it's completely different technology in France, so we're not suggesting that those numbers will be those experienced by Paks II, but we just take them as a proxy for what may happen if the expected scenario of the Hungarian government doesn't play out. What's the impact? As I mentioned, the most significant parameter influencing returns of such a merchant project is power price. Now, in the past, power prices were mostly modeled on expected kind of global price of commodities. International Energy Agency is probably the most renowned or respected institution to produce those outlooks. And annually they produce a publication called World Energy Outlook, where they summarize the developments and they build models which imply power prices for regions based on their say macro commodity model. The issue is that the German energy transition is significantly faster than the ability of International Energy Agency to update their modeling. So the forecasts used by the Hungarian government to take a view on this Paks project were essentially outdated at the moment of publication. So you see those two lines there. They show the old power price forecasts of International Energy Agency, and this blue line is the recent forecast. So obviously International Energy Agency updated their models in 2015. In early December 2015 they published new forecasts based on significantly updated model, taking into account what's happening in Germany, and also taking account the kind of low oil price world that we currently live in, and the result is a significant shift of power forecasts downwards. To kind of show how the economics of such a big project impacts on commodity prices, we built three price scenarios. So we built high scenario, base scenario, and low case scenario. I would draw your attention to the fact that the base scenario that we use is actually fairly aggressive, and I call it base only because it's somewhere between low and high. But my personal view is, and this is what we see playing out currently at market, that's the low scenario. This is the low oil, low gas, low carbon scenario, and this certainly seems to be the world that we live in and we will be living in for extended period of time. This scenario also assumes that the German energy transition will continue at its pace, meaning that German renewable power will be added according to German government policy. The high scenario assumes quite aggressive growth in carbon price, and what we see currently also coming out of Brussels, we do not believe that it is likely that carbon prices would reach levels of 40 to 50 euros per ton, which is what is assumed by this high scenario. What is coming from Brussels as a proposal to remedy the carbon trading scheme still produces significant surpluses on the market, and therefore it's unlikely that the equilibrium price would approach levels needed to get power prices this high. These charts illustrate why power prices will stay subdued for extended period of time. It's all down to German renewable policy. These curves are called merit order curves. This is how power price is formed on the power market. The power price is set by a power plant, the last power plant, the most expensive power plant, which is needed to fulfill the residual demand. This is where the price clears, and this is what all the other market participants receive, and this is the market price. So this curve shows ordering of power generation sources according to their cost of production. This is the price that power generators bid on the market. If we assume low load factor of wind and solar sources, then we see that the system price is relatively high, driven by hard coal and lignite, depending on various efficiencies of the plant and also on the respective price of carbon. The lignite-fired power plant have significantly higher carbon intensity than hard coal-fired power plants, and therefore, if the carbon prices increases, then the power price is more determined by hard coal-fired power plant. The renewables, especially photovoltaic and wind, can bid zero prices on the market, and this is because their investment is amortized from another revenue stream, basically from a subsidy awarded to them by the government. Therefore, they don't need any income from the wholesale market. They just need to place their megawatt hours on the market. And therefore, they're not really motivated to curtail their production. Their motivation is to max out their production, produce as many megawatt hours as possible, because their remuneration is directly linked to the number of megawatt hours they produce. So, and the impact on that we see on the other slide here, where we assume, for example, relatively windy and fairly sunny day in Germany. And you see how, other things being equal, the system price decreases significantly, and now the market is essentially closed by a nuclear power plant with correspondingly low costs of production. And this is what's happening. And when you see the pace at which Germany is adding renewable sources, you actually see even nuclear power plants being pushed out of the market and unable to cover their costs of production. And this phenomenon leads to prices which approach zero, or at times even fall below zero into negative territory at times of low demand and high output of wind and solar energy. And this phenomenon fundamentally impacts all power generation projects in the whole of Europe, because through grid connection, this phenomenon is imported by all European countries. Another reason why power prices will unlikely grow is demand. Demand has stayed subdued. There's no particular reason why demand should be increasing. In fact, in Germany, it's been decreasing despite robust GDP growth. With all the energy efficiency measures and changes in structure of industry, there's no fundamental driver for demand increases. I was talking a lot about renewables in Germany and how they push power prices down. This chart just compares generation in Hungary and Germany. Although the absolute amounts are significantly lower, you see the same trend or similar trend. So you see the same phenomenon playing out in Hungary as well. Now, the result of the modeling, when we assume all those various power price forecasts, those are summarized in this table. So the result is that the net present value of the project is negative across all scenarios, meaning that no investor would invest in such a project. The project is investable if net present value is at least equal to zero, which means that it would yield to its investor the equivalent of its cost of capital. Under those simulations, we see that no scenario will lead to a situation in which investor would recover its cost of capital. Now, we assume the cost of capital as published by the Hungarian government to be 7%. I doubt that this is realistic cost of capital. My view is that this weighted average cost of capital seriously underestimates the real cost of capital. And if this asset would be considered, say, a commercial asset, you would be looking at a cost of capital at least double than that. And this is because the merchant risk of the power plant, this power plant is solely dependent on power revenues, which change with daily volatility. So it's a very risky investment for all banks, investors to provide financing. There's no certainty that power price would be 60 euros per megawatt hour or 40 euros per megawatt hour. No one knows. And this risk, this volatility, is transferred into the cost of capital. So typical merchant plants even with, say, bond profiles like Germany, would need returns of higher than 12% to attract investment. So if Hungary is saying that this project can get financed at 7%, it means that they're already offering massive subsidy to the project, because the cost of capital could be pushed this low only because, for example, the Hungarian government would guarantee offtake prices for the power plant. And this, of course, amounts to state aid. Or the Hungarian government would guarantee loans to the project, which is another tool used to push cost of capital down. Now, then the question is how much a company which would build and operate Paks II, how much would they pay back to the Hungarian government for providing those guarantees. We've seen the same issues with Hinkley Point project, and there is no clear answer to that. Essentially, it's very difficult to price those guarantees at a market level because there's no market for bank guarantees for nuclear projects. So if we're saying that weighted average cost of capital of the project would be 7%, we're saying basically that Hungarian government's providing a massive subsidy to the project, either through guaranteed offtake prices or through providing bank guarantees for construction financing, or a combination of the two, as we've seen with Hinkley Point. Now, the reason for those negative results is the massive capex of the project and also very long time of construction. So this chart basically shows that although the project would likely generate positive EBITDA, so would likely generate positive cash flow to the investor, it will not be enough to amortize this massive investment spread over time. So any investor, of course, would have to start paying construction loans here, but then the first revenues will come there. So this is this time delay between when you actually draw the money down and when you start receiving first revenues. This is another factor which influences return of the project. And we haven't made, in fact, any assumptions about delay of the construction. Any delay would any shifting of this black line here would only lead to further decrease in profitability, and we just stick to Hungarian government's timeline for the project. Now, you may ask, so what are the alternatives for the project? And so on this chart, we modeled the cost of electricity per megawatt hour of other comparable sources. So for Paks project, we model maximum, which assumes the maximum given cost for operation and maintenance of the power plant, and the minimum uses the minimum stated cost for operation and maintenance. And so if Paks was built, it would need to sell electricity for somewhere between 85 and 105 euros per megawatt hour, which is significantly above the current power price and significantly above any power price forecast by any institution of the world. To compare, the Hinkley Point project is significantly more expensive than Paks II as it exists currently on paper. So Hinkley Point project would need even higher subsidy of more than 120 euros per megawatt hour, and this may be one of the reasons why the project's gradually falling apart and slowly dying out. In contrast, we also model the cost, or say the power price at which wind and solar need to sell their energy to return profit to investors. And for photovoltaic in Germany, we see the cost, in fact, going down from more than 80 euros per, or say 90 euros per megawatt hour to about 75 euros per megawatt hour in recent auctions. And this should look even better for Hungary, with significantly better irradiation in Hungary than in Germany. Onshore wind in Germany is probably the cheapest source, needing about 60 euros per megawatt hour. And again, there's no fundamental reason why wind conditions in Hungary should be significantly worse than those onshore wind conditions in Germany. And here on the right side, I just present the power price development so that you can appreciate the massive difference between the price needed by nuclear projects and where power has been traded over the past, in fact, 16 years. And even when you look at the peaks, power prices have never gone up over 80 euros per megawatt hour in that given year. Of course, in peaks, they would touch 100 euros per megawatt hour, but those peaks are not long-lasting, and they're simply not frequent enough to ensure amortization of a nuclear power plant which is producing at base load. So how much would it all cost? So if you assume the same megawatt hours produced by all those sources, you again find that that nuclear is the dearest for energy consumers. The annual cost of subsidy for Paks would vary between, say, 1.5 to 2 billion euros annually, which is still lower than what Hinkley Point would need, close to 2.5 billion euros annually, but higher than what recent auctions for photovoltaic suggest in Germany, and significantly above what wind generation costs German taxpayers. Now, what would be the impact on competition? So, before we start actually looking into how Paks II would influence market competition in Hungary, we first need to clarify whether we should be looking at Hungary as one power market, or whether we should be analyzing Hungarian power market as part of a wider European market. And when you just review power prices of, say, neighboring countries of Hungary, you see that they all look very similar. And you may be tempted to conclude that, in fact, Hungary is part of a wider European market, and therefore the impact of Paks on the market would be negligible, and therefore shouldn't be of any concern to competition authorities. However, this seeming similarity of power prices is caused by, say, macro issues of commodity prices, which affect all European prices in the same way. When you look at the power price declines recently, they are very similar across all neighboring countries. And this is mostly driven by the fall of basically global commodity prices. When you look at gas prices, they were in free fall with oil prices. When you look at carbon prices, also downward trend for a long time. Coal prices, which also affect the European prices, as the German price-setting power plant is mostly a hard coal-fired power plant, in total free fall. So when you add all those trends together, you actually think that the prices are the same. But if you clear the time series from the impact of those events which impact prices in the same way across the continent, and then you run a correlation analysis on power prices, you actually find that prices are not that much correlated. The correlation analysis is summarized in this table. So this column shows price correlation between Hungarian and German power prices. Now, if that correlation was high, say, over 80, then you would conclude that simply that Hungary belongs to a wider European market, and there's no issue with Paks from the competition point of view. But in fact, Hungarian prices are not that much correlated with German prices. The transmission capacity between Germany, Austria-Hungary, Czech Republic, Germany, and then Czech Republic, Austria, and through Slovakia with Hungary isn't sufficient enough to deliver this high correlation. We see similar picture with the Slovak prices, with Romanian prices, and just as an example of how one market looks like, we calculated price correlation between Czech and Slovak markets, which, as you all know, historically was always one market, and then just it split. But from the infrastructure point of view, nothing really changed, and you still see very high price correlations between Czech Republic and Germany, which show that transmission capacity between Czech Republic and Slovakia is high enough to allow power transfers between the countries depending on immediate demand and supply conditions, and therefore this behaves as one market. Now, if we treat Hungary therefore as one market for this analysis, we see that Paks II would actually have significant impact on the Hungarian market. Here we just, for illustration, show the concentration ratios which are considered high by US and European competition offices, and if, for example, proposed merger or project has a potential to break through those thresholds, then it is reviewed by the competition authorities for approval, whether it wouldn't have negative impact on the market. So I think, again, it's important to mention that if a market has higher market concentration than shown here, or a proposed merger or new project increases those significantly, then it doesn't automatically mean that such a project is abolished. It only means that it is reviewed by competition authorities, and competition authorities may impose some remedies which may alleviate the problem. For example, demanding a company to offload some other assets. We see that Hungary is a relatively concentrated market already. Of course, when we count with imports, the market concentration drops, but is still above the thresholds generally regarded as concentrated for the market. For the analysis of impact on competition, we use two scenarios based on two government strategies. One is nuclear, one is green. For the nuclear scenario, we find that basically most of the power generation would be owned by or controlled by Hungarian government. For the green scenario, we assume, that is because we assume that the investor into Paks II project would be Hungarian state or state-controlled entity. For the green scenario, we assume that the investors into the renewables will be more evenly spread, for example, in line with what we see, the kind of capital deployment in Germany. So it will be more smaller investors rather than one massive investor coming in and filling this area. So the impact is then summarized in these tables, which show that with Paks II, the market would be just dominated by the Hungarian state. If Paks II runs together with Paks I, then we see that the market concentration ratio becomes very high, basically comparable to only Belgium from European countries, where the power mix is dominated by nuclear generation of a state-controlled company. Even France would have lower, with EDF playing dominant role, so even France would be better off. Not by much though. And when Paks I goes out of line, then still the market concentration ratios would be relatively high compared to other European countries. With the green scenario, the market should be competitive and therefore delivering best outcomes for Hungarian consumers. So to conclude, we believe that the Paks II project simply cannot be considered a commercial project. It simply doesn't yield enough without state support. State aid would be required to get this project going, and it would be significant state aid. So in the end, whether Paks II will be built or not depends on how much Hungarian government is able to get away with in terms of asking Hungarian electricity consumers to pay for the power plant they don't in fact need. The impact on competition would be significant, definitely until 2030, when Paks I and Paks II will be running together. And thank you for your attention. I'm happy to answer any questions you may have.
Thank you very much. I'd like to welcome you too. And now I'd like to, in just very short, talk about something Jan did not talk about. Jan mentioned that his calculations were based on assumptions that were provided by the government in order to be comparable. So we decided to take the assumptions and calculations of the government in order to be able to model the economic feasibility of the project. From the Greenpeace point of view, I must say that we do not accept the calculations of the government, because we strongly believe that there is a very high chance that the financial calculations will turn out actually much worse. When we through the Rothschild analysis, which was commissioned by the government, then it seemed very similar to a wish list a child would present for Christmas. And if a child wants to have an Xbox, it does not mean that Santa would actually put that into his stockings. And I believe that often children have actually less under the Christmas tree than they hope for. So that being said, let's just move on to our conclusions. So we often mention, and we have mentioned it many times before, that the cost of the project, which is now defined as a 12.5 billion euros, would already put the entire implementation of the project into question. Historical example clearly show that the cost of the projects are always much higher than first planned. So what we can see that the Finnish example, which had 3.2 billion euros as an initial price, is now almost 3 times as much as it used to be, and the Muki 4 project shows a very similar trend. So the question is, what are we going to have in the case of Paks? We are not quite sure that it's 12.5%. What the contract includes, what exactly it means, because we strongly believe that it does not cover, or it might not cover, because we are not quite sure about the content of the content, not cover costs that are also related. For example, when it is put into operation, we might require certain implementation, certain investments that will be borne by the Hungarian party and not the Russian. So we can see see that there are further investments needed, the Russians will definitely not go pay for. There are certain blocks that will need to be much larger. For example, the reserve capacity blocks, they have 500 megawatts up to, and it has to be increased up to 700 megawatts. No one is talking about it in the government. There's a big silence about these reserve blocks and how they went to finance this increase. Furthermore, we are very well aware that the government is already spending money from our national budget on this project, even though we do not receive any services from the Russian part. We have to pour money into the project company. They do not have any income, they only have costs, and we have to cover the costs. So the national budget will cover this cost. Again, we have no details, and the government tries to not talk about it. What we know that 28 billion Hungarian forints were allocated last year, and this year 113 billion from our national budget. But how much we spent last year and how much we have spent so far this year, again, it's completely unclear. What we do know that when you are doing their calculations, then they take this 12.5 billion as a basis, and they do not talk about and calculate with the additional costs. So what about the utilization of the project? They believe that 92% of our energy demand will be covered by the power plants. Compared to that, we know that its blocks do not even reach 90% at the moment. We also know that they have to be participating in the primary regulatory framework of the Hungarian framework, and I'm sure that will further reduce this utilization. Also, they do not calculate with the 6, 7 or 8 years while the two are running parallelly, then they will basically operate on the very same market. So let us call it a cannibalization process. So the nuclear capacities will actually try to gain markets, destroying each other's markets. So that's why we refer to it as a cannibalization. Also, we do not see that they are calculating with the additional cost that might arise in connection with introducing a prototype, and often it takes a couple of years until we can reach normal operations, and that should also be calculated with. We can't see that they calculate with risks such as the low level of water of the Danube, and also what we are missing in the calculations that we saw that on Jan's chart that renewable energy resources will gain importance in our energy market, and they will have a higher market share. And again, they did not calculate with this. So the next slide is also very interesting, at least I believe that. It is discussing the net performance, because we mustn't forget that it has also its own usage of energy, because obviously we have to operate various blocks. So also they can only deliver energy less than what they produce and generate, because they also need to use some energy. In the Rothschild analysis, we heard the number of 1,180, but it seems too little in order to be also be self-reliant. However, from DG competition, we received a letter that they are talking, they also mentioned that they are calculating with 1,180 megawatts, but in other communications coming from the government, I heard 1,113, and this was clearly communicated by the government, and it was at the time when they tried to talk about the economic feasibility of Paks II project. So it seems to me that they actually communicate something very different towards the European Commission than to our country. Also in the environmental impact assessment, it clearly is shown that they are talking calculating with 1,113. So from various sources, that's what we can see. So this is a difference of 67 megawatts per each block. But if you are talking at an annual level, then it is an increase of performance of about 5 to 6%. This is 1 terawatt hour all in all. So just to give you an idea, Paks I is able to produce about 15 terawatt hours. So compared to that, this 1 terawatt, which is the difference, is something to be considered. So we definitely need to find out about the exact calculation. So concerning the WACC, our partners decided to go on with the calculations of the government, which was 7%, but we also can see that it is not very much in line with the reality. Based on the Commission's DG Competition's letter, we can see that 8.3 or even 10% would be more realistic if the project is implemented by 50 or 60% of own capital financing. But if we consider 100% of own capital financing, then actually the WACC will be as high as 13% or even higher. So this is almost the double of the amount what the Rothschild analysis was calculating with. So if we are talking about a double amount of WACC, then obviously it would have an implication on the costs. So what about the time frame? I think it's again an issue that we believe is also very much underestimated in the government's calculations. So it seems to me that they overestimate the incomes and underestimate the cost-related calculations. But also the time frame for the construction is also very severely underestimated. They said that they would start in 2008, and by 2020 or 2025-26 they would be able to start the operation. But we just took a closer look at the reference power plants in Russia, in, for example, Leningrad and Novorossiysk. We can see that the two blocks there will be implemented in about 9 to 10 years, according to recent plans. So they started in 2008, 2010, and according to the current estimates, they will be probably finished in 9 to 10 years. Or if we just take a look at Paks blocks, then we can see that it took about 7 years. So therefore, we do not think that it is realistic what the government said about the time frames.
So the expectation of building this in 7 years. So if we can only manage to finish this in 9 or 10 years, the construction, then we will face the problem that the loan taken from the Russian government we will already have to start repaying on the 15th of March 2026. And there is no clause in the agreement about what's going to happen if the reactors are not operating yet and not completed. And then just a remark that we see that this delay has already started, according to our opinion, because the construction, as it seems like they already have problems, even though the construction hasn't even started yet. The whole program is delaying. So we can see the years here that the environmental permit they should have already received last year, but this is still in progress, and it seems like there's a 1-year delay already in this area. And also the site license they wanted to get in 2016. The site inspection process is still going on, so it seems like the site license process is going to be completed next year, maybe. So it seems like the government is already in great delay. And then two other small remarks to conclude my presentation. We often hear that the Russians had a turnkey agreement, which means that if there are any problems, the Russians will pay. And we have already seen this on the market. We have an example for a power plant like this. We can see that the costs have already doubled there, and the result was that there is a dispute in court now, and the case is in front of the court, and they are arguing about which party should be held responsible and liable and finance which delay and which cost increase. So we are not sure that the Hungarian party is completely protected from these problems and issues. It's very interesting also how they distributed the risks, and the EU assessments and the environment permits are still in delay, and if they manage to conclude an agreement that the Russians will pay for all this, and this is an agreement that no one has expected actually, and no one has been considering these serious risks, who is going to bear the risks. And then the foreign exchange risk, we haven't talked about the currency exchange risk yet. This has been a big problem in Hungary, so we know this. So the loan will be taken in euros. However, the revenues will be generated in foreign. So there is a risk here as well. And probably the Hungarian state will take the loan, which means that the Hungarian state will have to bear a significant part of this risk as well. This was what I wanted to say briefly, and thank you for your attention. Then you are welcome to ask any questions.